Good morning, I'm Dale Mesnick. I'll be your room host today. The title of this workshop is Navigating the ETA Deal, a step-by-step guide and current market trends. I'd like to introduce Lloyd Bell. Lloyd is Director of Corporate Finance at Meeting & More, specializing in business valuation, corporate finance, and growth strategies. Please welcome Lloyd.
Thank you. Thank you, Dale. Can you hear me through this? Yes. So I have a tendency to wander in a good way. My wife's listening. Thanks for coming. This is a topic that I always find very interesting. I've been doing this at Meeting & More for about 30 years now. When I first got out of school, I was actually going to be a banker, which I used to think back then it was a sexy career. I later learned once I came out of banking that it really isn't. When I went to Weatherhead at night and never got to come to these nice buildings, I was across Euclid in the old Enterprise Hall, and I'm very excited to see the changes at Weatherhead and what they're doing within the community. And when I came to the ETA event last year, I thought, what a great organization. It really supports the type of stuff that I do professionally and the stuff that I think is important for our community. So the topic today is navigating the ETA deal. What I'm really going to talk about is sort of getting you to the letter of intent. And has anybody here successfully gotten to a letter of intent? Okay, nice number of people. What I'm going to talk about are generalities. No two deals are going to be the same. What I'm going to touch upon should cover most deals, but again, everything's going to be a little bit different. What's important to keep in mind is that the LOI, as those of you who have been there, is not the finish line. That's just the starting blocks. There was an article in Forbes magazine a couple years ago about post-LOI and successful closings. About half the deals don't close after LOIs. And in my experience, it's not been half, it's probably been about a third of the deals don't close after the LOI has been signed, and there are really 4 reasons that the Forbes article points out why the deals don't close. Number 1, the LOI is poorly drafted. And I see that a lot in some of the deals that we get involved with. What I'm going to talk about this morning are some of the things to think about when you're constructing that LOI. Number 2, poor communication between the parties. And really what that relates to is when you're the buyer, you're trying to find out information from the seller, they're not very responsive. They have a hard time getting you the information. They're slow. The information is poor. It just leads to frustrations on both sides, and the deal can fall apart. Number 3, believe it or not, outside advisors tend to kill the deal. I'm not saying it's always the attorneys, but it's always the attorneys that they want to. I mean, they're looking out for their client's best interest, trying to protect them through the agreements. And you can only go so far before one party says, enough. I'm done negotiating this transaction. And the last is the business performance declines between the time the letter of intent is signed and when the deal closes. While we might put a 90-day window on a letter of intent, it's not uncommon that they stretch out longer and longer. And during that period of time, it's not uncommon that the business performance starts to decline. And you may be able to renegotiate the deal, or maybe the deal just dies. So what I'm going to talk about this morning is the information you want to obtain, sort of broad strokes, what type of information I like to see on the front end. Talk about getting to that letter of intent, the structure issues that you want to include within that letter. I'm going to talk about purchase price multiples. Everybody loves purchase price multiples. It's the aphrodisiac of the deal world. They love to ask about those. I'm going to talk about purchase price multiples, and then I'll briefly finish up talking about post-LOI diligence. So when it comes to the information, and again, feel free, stop me anytime, ask a question. Happy to answer them or make up an answer that you think is real. I ask for this information on the front end. I don't always get it. When a seller is working with an intermediary, it may make the process easier, it may not, but at least when there's an intermediary involved, they tend to know what information could be shared, should be shared, and when. Whereas when you're working directly with the seller, they might not know what they can share, how far they should go. Should I tell you about my customer name? Should I give you this, all this detailed information? What I like to look for is, first of all, what does the company do? What are the products or the services that the company provides? If we can get financial statements for the last, or tax returns for the last 3 to 5 years. When I first started getting involved in this business, we thought 5 years was a good reflection of a business cycle. I don't know how long a business cycle is anymore, because the business cycle just seems to kind of putter along. It used to be somewhat more predictable. Now it's just, there's no consistency. Interim financial statements for the current year and the prior year, which will allow you to calculate that trailing 12-month performance. And I put a projection up here. I would say my success rate of getting a projection is probably under 10%. Most companies in the lower middle market do not prepare any types of forecasts. At best, you might get a sales forecast, which is, quite honestly, it's aspirational. It's something that they want their sales team to try to hit, but they really don't have any expectation that they're going to hit that. So it's very difficult. I asked for it, I'm not going to get it, but might as well make them feel bad about their inability to provide information. Very important, seller's adjustments. You get a set of financial statements. Is that truly reflective of the sustainable level of performance of the company? Or is there something that we should know about? Are there non-recurring or non-economic income or expense items that are running through the business? The add backs. The sellers always, they can often be a little bit aggressive in what they view as a legitimate add back. Some of the more obvious ones are their own compensation, which is great. So apparently they're not relevant to the ongoing operation of the business, and so their comp should be added back. I think in reality, we ignore that one in 90% of the cases. But we've seen a little bit of everything over the years, as you can imagine. Daughters' weddings as an add back. Divorce attorney. I don't know if the two were, I don't think it was the same client. But the point being that obviously it's not unusual for companies in the lower middle market to use their company as their personal checkbook, which is fine. I've had them ask, do you have to tell anybody if I tell you? Do you have to report this? I don't report this to the IRS. Just come clean, because it's helpful to the buyer, for you to understand what is that sustainable level of earnings going to be when you buy the business. And then understand any concentrations of customers, or if there are any individuals that are really key to the ongoing operation of the business. From that information, we can start to build some preliminary models that gets us in the ballpark of what the value should be. I'm not going to go into gory detail as to how you value a business from a technical standpoint. We'll talk about how we kind of do it in the transaction world. There's probably not enough coffee out there to go through a primer on business valuation. So let's talk about getting to the letter of intent. Step one, value the business. So from a theoretical standpoint, the value of a business is the present value of the cash flows that will accrue to the owner. And you use a discount rate, which is reflective of the risk in the investment. It's pretty straightforward, right? The reality is, well, let's talk about risk. Risk of investment. You can put your money in anything. So up here I've got a couple different investment opportunities. You've got U.S. Treasuries, which are considered to be risk-free. Politics aside, they're risk-free investments. And right now they have a return of about 4.1%, which is equivalent to a multiple of 24 times. You could invest in the S&P 500, which long-term has had a return of 10.5%, which is a multiple of 9.5 times. Or you can invest in this sort of a diverse portfolio of publicly traded stocks, which have returned a little better than 14% long-term, which is a multiple of 7.1 times. So when I'm looking at one specific company, what is the risk of that company, and therefore what is the appropriate multiple that I'd be comfortable paying for it? So risks are everywhere, and I have up on this slide just sort of an example of some of the risks that you might find in a business. You have a question?
Yeah, so when you buy a smaller business, so much of it is the value of that person who's created that business, their relationships, whether it's a construction company or a service-based business. And if that person's leaving because they're selling you their business, how do you quantify that?
Yeah, that key person risk is the question, how do you quantify the risk of the seller who has those relationships with the customers? It's very, very difficult. There is no mathematical formula to do that. You can try to mitigate that through, obviously, non-competes, consulting agreements, et cetera. But when you're coming up with that risk or the multiple you're going to pay, maybe you factor that in sort of subjectively, that there is a possibility that the business won't be there. Now, you can also bridge that value gap through the use of an earnout. We'll talk a little bit about that, so that you're protecting yourself on the downside while still giving the seller the upside if the business holds up. But it's a very real problem.
Well, yeah, I've done 2 acquisitions of accounting firms. I'm a CPA, and were the most expensive education I've ever had in how to F up a deal.
Yeah, I don't know why anybody would buy an accounting firm. It's challenging. All you're buying is people. I mean, you think you're buying the client base, but you're buying the people.
And when they all leave,
When they all leave.
2002 or 2022, and you can't find another body to come replace them,
Right.
the clients leave pretty quickly.
That's exactly right. And that's why, obviously, I hope you structured a deal that was a sort of contingent payouts over
No,
time.
and I'm still paying for it.
Well, where were you 5 years ago? I should have helped you on that. No, you're exactly right. When you're dealing with something where the primary asset is an individual, professional services, it's very challenging to structure that deal because that's a huge risk. There's some other risks up here on the screen. With customer concentrations, you see that a lot, and I'm not going to go through all of them, but you get the point that there are risks that you will identify on the front end. You'll also identify more on the post-LOI diligence. But bottom line, you cannot mitigate them all. You can't get rid of them. All you can do is acknowledge them and try to factor that into your pricing. At a certain point in time, you have to take that leap because being an entrepreneur is being a risk taker, right? If you don't want any risk, go buy treasuries. Get your 4% return, you'll be happy. But if you want to take some risk, understand as much as you can, but know that you're going to be accepting some risks that maybe you don't know. So again, that theoretical approach to valuation, in my perfect world, you're taking a set of forecasted financial statements, you're putting them out 5 years, you have a terminal value, you're bringing it all to a present value using a discounted cash flow with a discount rate that's truly reflective of the risk in the business, but we don't live in a perfect world. We don't get those forecasts. We can't quantify that discount rate with any real certainty. Now, if you're a business appraiser, you can go away for a week and learn about the development of discount rates, and you can read books, you can buy books, you can do CPE. It's ridiculous how much time is spent on the derivation of a discount rate in buying a business. I'm sorry, valuing a business. In reality, what we do is we take an earning stream times a multiple. There's no real sexiness to it. It's an earning stream times a multiple. Most of the times what we're talking about earnings is adjusted EBITDA, and the multiple is really based on what other companies sell for. It's rather subjective, and I get asked this question all the time. What's the right multiple? What are the multiples right now for plastics companies? I don't know. I can look up what the averages are from our databases, but is that appropriate for this specific company? Probably not. Again, they're averages. Some are going to be above, some are going to be below. The average high for October 22nd, which was yesterday, 61 degrees. It was 78 degrees. So the averages, over time, sure, over a database of transactions might get you close, but it's not appropriate for valuing your specific company until you've done the diligence on the risks in the business, and also, quite honestly, the sustainability of the earnings. We kind of take for granted that our adjusted EBITDA figure is the earnings amount. But what's driving that EBITDA in our current trailing 12-month period? Is that subject to change going forward? So the value is part one. Now we talk about the structure, the types of items to put into your letter of intent. What's being purchased? Is it the assets of the business or the stock? I see a lot of letters of intent that are silent to this, which is curious to me. Because if I'm selling my business, I want to know, what is it that you're trying to buy? Do you want to buy my stock? I want you to buy my stock. I can get better tax treatment. You want to buy my assets. You can avoid any liabilities that might be out there. You can write up the value of the assets. Things to be aware of, however, the company might have some agreements in place or some licenses that are not transferable under an asset sale. So you might be forced into a stock transaction. In that case, what I've got up here is sort of consider a 338H10 election, which is a stock sale which is deemed as an asset purchase for tax purposes. I'm not going to get into the details on that because I'm not a tax person. I just know that it's a very handy tool to get both parties to agree on a transaction. Just be aware that the buyer generally has to pay a little bit more to make up that tax differential that the seller has to pay. Are certain assets and liabilities excluded? For the most part, we're dealing with transactions that are cash-free, debt-free. That's a given in most situations. But there are other assets that are not going to be included. The real estate is a prime example. Is that something that's going to come with a deal or not? And if not, is there going to be a lease put in place? We've had clients with RVs, on lots of personal autos on books is not unusual. You want to make sure those things are not coming with the company. Now, what I want to have you keep in mind is when you have an earnings times a multiple, that really is the value of all the assets and operating liabilities that drive the earnings. And it's not uncommon for some of these smaller companies or the sellers to say, well, I want to keep the receivables and the payables. And they think it's for your benefit, to be convenient. It's not. It's not convenient at all to the buyer. It hurts your cash flow out of the gate because you don't have receivables coming in. And quite honestly, that multiple times the earnings assumes that that working capital level is in there. So if they want to keep that working capital, you want to adjust the purchase price accordingly. Is the price subject to change? So obviously we assume when we issue the letter of intent that everything's going to stay as it has been running, but sometimes it doesn't. And one of the things that can change is the amount of working capital in the business. So those of you that have been through this know that we want to set a working capital target as part of the deal so that if at closing the amount of working capital that is on the balance sheet differs from what we modeled, we want to adjust the purchase price upwards or downwards accordingly. And that's to prevent situations where a seller, I'm not saying they would, but the seller could conceivably collect their receivables and not pay their payables, and suddenly your working capital is upside down when you've been modeling it a little bit differently. So it's a nice way to really make sure that what you're getting is what you think you're going to be getting. Is the current level of earnings sustainable? And this is what, Paul, we just talked about with your deals. Is it sustainable going forward? We don't know. We got to take that flying leap. But if there's any amount of uncertainty, you want to maybe have some contingencies in place, like an earnout. It's a good way to minimize the risk to the buyer, whereas you're paying the price that you think is the sustainable level of earnings, and you'll pay a higher price if those higher earnings that the seller says is going to occur actually occur. The earnouts are generally 1 to 3 years. They can be set on any number of metrics from sales to profits to EBITDA. That all can be negotiated. You don't have to put in the letter of intent how the earnout will be structured, but I think it's important to have in there that there will be an earnout of X dollars so that the seller knows that this is going to be part of the consideration, because otherwise they might expect that all of it is coming at closing. Are there any key employees? I kind of talked about this in the risk section. There may be an engineer or engineers on staff that are really integral to the ongoing operation of the business. There could be a stellar salesperson that you can't live without. And what you want to do within this letter of intent is say that your intention is to have a successful employment agreement with these individuals. Again, we don't have to put out there what we're going to pay them and for what period of time. We just can say that we need to have employment agreements with those folks as part of the deal. How are you going to fund this? Now, this maybe is not something that you need to put in the letter. I have seen this in some letters of intent where the buyer has put in there the capital that they have available to them. But this kind of goes hand in glove with the valuation and the structure of the offer. Your ability to borrow is going to be limited by your capital providers. It's exciting to come up with a number and say, I've got a willing seller who will sell me his business for $8 million. But if you don't have the funds, will I go forward? So you really need to understand how much can this business afford to borrow, either because of its collateral or its cash flow. What are the current sort of capital providers? What are they willing to provide for something like this? How much equity do you have to put into a deal? How much would a seller be able to put into a deal? You have to figure that out on the front end. Otherwise, the offer that you put out there is just going to be meaningless, and the deal is going to fall apart, and everyone's going to be sad. I put up here, I mentioned this SBA 7A loan. It is an outstanding tool for funding acquisitions on the lower middle market. I see a lot of these deals right now. The banks love them because they can offload the risk on the SBA. Borrowers love them because they will finance airball, so intangibles in the business. They don't need to have the collateral coverage that a traditional bank loan would have. So it's a great great tool available in the lower middle market, and I assume Kylie will be talking about that later in her session. When do you anticipate closing? We want to get this done as quickly as possible. Put 90 days in the letter, but don't be surprised if this takes longer than 90 days. What's very important to do on the front end is make sure you have an experienced M&A attorney on your side, and maybe get your banker involved on the front end as well. The attorney, though, is really, really important. I would encourage you to use the attorney for the letter of intent, but we've had deals where the seller has used their sort of the corporate attorney or the guy that did his will and has never really done a deal before. And it gets to the point where the buyer's attorney is trying to negotiate with the seller's attorney who is making a stink over things that are nonsensical or standard in purchase agreements. And
And don't be cheap and try to use the same attorney for both sides because it will bite you majorly.
don't use the same attorney. And would you do that for your divorce? I mean, come on, you wouldn't do that. Use different attorneys. You have to have someone protecting your interests, and the seller can have the attorney protecting their interests. Okay, this is what everybody wants to hear about, current purchase price multiples. Please don't price any of your future deals on what I have on these slides. Just, yes, well, we're not going to do that. Well, this will get you in the ballpark, but don't just say, well, Lloyd said the multiple is this. Lloyd is going to say the multiple is this, but Lloyd doesn't mean it. So right now what we're seeing is multiples are really holding up. You know, there was some question when the interest rates started to shoot up in 2022, will this have an impact on purchase price multiples? And I can say in my experience in the transactions, the answer is no. I'm going to show you some data that suggests maybe it did. But those multiples have been holding up because there is still a lot of cash in the system looking to do deals. And when you have a lot of cash out there, a lot of demand to buy deals, it tends to keep the asset prices high. At the same time, we're starting to see a little bit of an inflection point in terms of companies' performance. So coming out of the pandemic, companies' performances generally, I'll speak in generalities, were pretty strong in 2021, and then pretty good in 2022, pent-up demand that these businesses had. 2023, it's still held up, but now in 2024, we're starting to see a little bit of a crest in the financial performance of a lot of these businesses. And so you want to be cautious. Where are we in that cycle of the business? Because I don't want to price it off of the peak because it's only going to go down. You can price it off of that with an earnout maybe, but you really want to be mindful of where we are and how sustainable is the current level of earnings. So we're starting to see a little bit of a tapering on that right now, excuse me. So now some numbers. This chart was taken from a database of GF Data, which polls private equity firms only on the deals that they have done. And I show here the last 3 years plus the year-to-date 2024. That shows the average purchase price multiples paid by enterprise value of the company, the 10 to 25 million on the low end, and then 100 to 250 million on the high end. What I want you to take away from this slide, other than the fact you're all going to see 6 times is the multiple, what I want you to take away is that there has been some consistency year after year after year in each of these size groupings. A little bit of a drop off in a couple of them for the 2024 numbers. I don't really put a lot of stock into that. I think some of that is going to correct itself when more data becomes available. But for the most part, they're holding steady. But what you do notice is there a clear difference between the smaller companies and the larger companies. The multiples paid for the larger companies are higher because they are considered to have less risk. We've never seen a large company go down, right? Large companies don't tend to have customer concentration issues. They tend to have deeper management. They tend to have a stronger market position than a smaller company. And there's more sources of capital available to fund their deals. You think about the lower end, I would use a laser, but it apparently doesn't work. The 10 to 25 million, that's being funded by a bank in all likelihood. You get to the larger deals, that's being funded by banks, non-bank lenders, mezzanine funds, the types of funds that are really not available in the lower part of the middle market. So I'm going to show you a slide that you're not going to be able to see anything on. You might be able to see the image. Looks a little bit like a, I don't know, I'll call it a very loosely defined triangle. This is another database called Deal Stats that has transactions, again, in the lower middle market. And this is a chart that shows by industry. And what I think, a couple takeaways here. The gray bars are all time. Now, I don't know how far back all time is. And the brown bar is the last 12 months. And you can see there's some consistency with each of these industries. A couple things to note. Number one, there's a blue line that runs across the whole thing that says 4.1 on the far right. 4.1 is the average multiple paid for all these businesses, all time. So we kind of have it in our heads that when we're buying a deal, it should be 5 times, 6 times, 7 times, 8 times. It's not really what's happening in the real world. A lot of companies are selling for considerably less than that, on average 4 times. You can see within industries, there's some great differences. Now, maybe throw out the big spike in the middle, which is information. That's it's going to be affected by a couple transactions. And the one immediately to its right is finance and insurance, also high multiples. But what makes one industry higher or lower multiple than another is going to be really a function of a couple things. CapEx needs, think about manufacturing has high CapEx needs. So you've got an EBITDA number, but from that, you've got to really deduct how much is ongoing capital expenditure needs. Whereas if you have information company, you don't really have CapEx needs. So you can have a little bit higher purchase price multiple. Growth expectations. The higher the growth expectations for a business, the higher the multiple. To be technical, your multiple is your discount rate less growth, the inverse of that. So the higher the growth, the lower the discount rate, the higher the multiple. It's all math, but trust me, it all works. So a high growth company is going to have a higher multiple than a low growth company. Also, companies with levels of innovation. Of course, innovation tends to go hand in glove with growth. And sustainability of earnings is another one. If you look on the left side, you can see construction. 3.7 is the average for those. Construction firms, they've got a project and then it's done. They've got to find another project. So how sustainable is the construction industry? Now, some of the larger contractors that we work with, they seem to do pretty well year after year after year, but some of the smaller construction firms, you've got a couple jobs one year, maybe 1 job next year, and 3 jobs next year. Very, very lumpy. So there's a higher risk involved in buying a company that has sort of lumpy earnings, and so the multiple tends to be a little bit lower. From the same database, we look at, this is the median selling price to EBITDA from the third quarter of 2018 to the second quarter of this year. And you see this U shape. And you also note that the numbers are startlingly low. Like you look at the 2022 when it's 2.9 times as a median selling price. A couple things that I really want to mention from this one. Number one, I didn't see this. In the transactions that we worked with, we didn't see this dip in the early 2020s. This database has companies in all industries, so you're going to, including things like retail and restaurants, which not surprisingly would have taken it on the chin during 2021 and probably 2022. Actually, things were being sold, but not at a very high purchase price. So, and I think given the numbers of those transactions relative to the transactions involving, say, a machine shop, bless you, it's going to bring that median down a little bit artificially, if you will, and I can't peel those out from this data. But one thing to note is that on the far left side, you can see in 2018, it started to come down a little bit. And if you think back pre-COVID, in 2018 and 2019, we were talking about the potential for a recession. Things were slowing down. But we forgot about that in March of 2020 because everything shut down. So all bets were off. But things were starting to soften in 2018 and 2019. Now we're seeing a resurgence of the purchase price multiples, at least in this data. Again, I've seen pretty much flat across the board. Where you see, this is kind of ironic, the sort of the nadir here of 2.9, where then it starts to go up. That's when interest rates started to rise. It's kind of counterintuitive that the purchase price multiples would go up at the same time as interest rates went up. Because you would think it'd be the opposite. When interest rates go up, the purchase price multiples should come down. Well, it wasn't the case. A couple reasons. Number one, still high demand for companies. A lot of capital out there looking. Number two, and don't throw stuff at me, interest rates aren't that high right now. We've become very accustomed to interest rates of 1%, 2%. It's ludicrous. When I started in banking, interest rates were about where we are now. and we all did fine, right? You look at the average interest rates in the 80s, the go-go 80s, interest rates were higher than where they are right now. So, yeah.
Rates were at really low,
Yes.
and at 4.8, the rates aren't going to where they were in 2018. So it's kind of confusing on where the trajectory is in 24.
I agree. And I wish I had good answers as to why, we're in the same place in 2024 where we were in 2018 when we're in a different rate environment. Again, I think it's just because of liquidity, because of demographics. I'm sure we've heard about the baby boomers retiring and the need to exit their business. Now, I am a firm believer that the scale of this silver tsunami, which I think is an awful name, I'm a firm believer that the scale of that is grossly overstated. But I do accept the fact that there will be a number of businesses that sell over the next 10 years because of people having to get out of their, because they're retiring. But I just think with the number of businesses that are unsaleable, the number of businesses that transfer to the next generation, it's not going to be a tsunami. I think it's going to be a pretty good surfing wave. That's about it. Yeah?
Anything with like government stimulus, PPP, ERC money, would impact the cash available for acquisition?
Question was anything about ERC, PPP, does that impact the cash available for acquisitions? On the buy side, yes. On the sell side, when we value a business, whatever income they receive through ERC or PPP is irrelevant. Obviously, it's non-recurring type revenue that doesn't get factored into the valuation. It does, however, provide liquidity to the buyers because now they have $1 million, $2 million, $3 million, a lot of money came into the system that free money. Who didn't take advantage of free money, right? So yes, it did allow companies the ability to do some acquisitions. And did it serve to increase or hold up the purchase prices? Perhaps. Perhaps it did. It certainly made it difficult for my friends in the banking community to try to put money in the marketplace because they were competing with somebody who didn't want to get paid back. That's a tough competitor when your business is to loan money. So this slide maybe takes out some of the noise of these sort of businesses we're looking at, taking out the retail, the restaurants, et cetera, and we show, okay, I thought you wanted to come up and help. This shows sort of the trend over the last 10 years. Again, lower middle market purchase price multiples for some of these industry segments. And you can see that there is no big U-shaped dip like we saw on the previous slide. These have by and large held up year to year. There has been a little bit of diminution in value in manufacturing and wholesale trade the last couple of years. Again, asterisk, I don't believe too much of the current information until enough time passes and we can get maybe more information reported to these databases. But I think what this might be suggesting, what I'm taking away from this chart, especially as it relates to the drop in the manufacturing and the wholesale trade, is these are industries that require high amounts of leverage. You need to borrow money to do your CapEx. You need to borrow money to support your working capital. You need to borrow money to have your inventory in your warehouse. So if you're dependent on a fair amount of leverage to operate your business, note again that in 2022, interest rates shot up. So we see a little bit of the reduction in the purchase price multiples in this database. Again, I'm not seeing it in the companies that we're working with, but nonetheless, the fact it shows there are transactions being done at lower purchase price multiples in the last several years, most likely a direct result of the change in the interest rates. So like I said, I want to sort of touch upon the post-LOI diligence, and I want to hear some questions from all of you as well. Have a little conversation, if you will. But once that LOI is signed, again, we're not at the finish line. We're just in the starting blocks. Now the fun starts. Now we start doing our financial and our legal due diligence where we verify those seller's adjustments, for example, where we verify that the financial statements are reporting things accurately. We verify that the contracts that they have in place are transferable to a buyer, where we verify that the real estate that we're buying isn't filled with underground tanks. So there's all sorts of fun stuff that happens at this stage. It's the expensive part. So the checks start getting written. But you want to do the operational, legal, and the financial due diligence, as well as insurance and the HR, and increasingly what we're seeing is IT and cyber diligence. And there are people that specialize in all of these fields. And it's really, and I would certainly suggest that you don't try to shortcut the process and cut out any of these. You need to take a look at each one of these. Even if you don't hire somebody to do cyber diligence, talk to somebody who knows something about cybersecurity and just describe what the company does and sort of get their input on it. Again, you're not going to be able to mitigate all the risks that exist in the business, but you can at least try to identify as much as possible so that when you take that leap, you know kind of where you're going to step and what you're going to step in. And the last thing I would say is leverage your ETA network. I think you've got a fabulous group of people here in the room and in the other rooms next to us that are more than happy to help you in your process of buying a business. Plus, there's plenty of people that aren't here today that have been through the process. And I have found that it's not just the professionals, people like me that will, yeah, I'm happy to help you. Of course we're happy to help. That's what we get paid to do. But I have found that the entrepreneurs that have done it are also more than happy to help you with that process. It doesn't cost you anything. Talk to them about their experiences, what went well, what didn't go well. Really lean on those folks because they are the ones that can really help you through the entire process. So let me ask a question to all of you, unless somebody has a question about any of this stuff right now. Oh, yep, question in the back.
The multiples that you had up there when we went down to, no, go back further. It was one more, no, two more, there you go. So this is a 10 to $25 million valuation. What about valuations below that? Is there a lot of people that are here that are looking at businesses that might be $5 million in valuation?
Right.
Do you have any feeling for where those are?
Yes, yeah, great question. You know, where are the companies below the 10 to 25? And again, this database is only pulling from private equity buyers, so they tend to look at things that are a little bit larger. You as an ETA a buyer probably aren't looking at the same companies that they are. However, there is a increasingly blurry line in terms of where the private equity firms, some smaller private equity, maybe non-sponsored funds, will be looking for acquisitions. They might be your competition. Yeah, so these are this roughly 6 times for those. That's where I think, and again, this is, I hate that chart. This chart, I think, is more illustrative of where the values are for that sub-$10 million companies. They really are closer to 4, maybe 5 times for something that's attractive. Could be below 4 times if it's an industry that maybe doesn't grow too much. I think as a buyer, you'd love to get something for under 4 times. But what we're seeing in the lower middle market really is capped at 6 times. I mean, I had a conversation with a client last week because I'd done a valuation report and I sent it out, and he is a serial acquirer, and he goes, I can't believe your multiple. Your multiple's like 4.5 times. We pay 6 for everything. I said, well, yeah, you overpay for everything. But you also have a ton of cash on the corporate balance sheet, so you don't really care as much. I mean, you can afford to have a misstep. You can afford to pay 6 times and it's really only worth 4.5. But I can't afford to pay 6 times if it's only worth 4.5 times. So people tend to think that the purchase price multiples are higher than they really are or they really should be. It's a problem when the sellers believe that. Sometimes it's the worst position to be in is the first person to make the offer. Right? Have you been there? You're the first person to make the offer and the seller is just offended. What do you mean it's only worth this much? It's about all it's really worth. Be the second person coming in there. Give that same offer, and then maybe they'll take it seriously. Yes?
Why don't you clarify and give with an example the difference between what you mentioned between buying stocks versus assets?
The difference between buying stocks and buying assets. So I'll try to keep it simple because I don't understand all this tax stuff myself. You know, I'm a simple guy. So you can buy the stock of the company. So you become the replacement shareholder, okay? So any assets, liabilities the company owns are now yours, all right? If you, and the accounting treatment that's been going on with the company continues on the way it has been. If I buy the assets of the company, I'm not buying all the assets maybe. Maybe I am, maybe I'm not. But I'm buying the assets of the company. I might assume some liabilities, like the trade payables are usually assumed, maybe some accrued expenses. but I'm not going to assume any liabilities that may exist for litigation claims, for environmental problems that may exist, any skeletons that might be in the closet that the buyer or the seller is aware of or maybe isn't aware of as well. So if you buy the assets, you don't have those legacy liabilities that come along with the stock of the company. Again, but you might not be able to get all these contracts or licenses that go along with it. There is a difference from a tax perspective how it's treated. So if I'm buying the stock, if I'm selling my stock, hopefully for more than what my basis is in the stock, it's a capital gain. So it's a lower tax rate than if I sell my assets, it's sort of a blended tax rate, and there's some ordinary income rates. I'm going to pay more in taxes. So I'm not interested in that as a seller. As a buyer, you're interested in that because, again, I don't want the liabilities. I want to be able to write up the value of the assets so I can write them off, like the fixed assets. I can attribute more value to that, write it off faster, and get a deduction that I couldn't do if I bought the stock. But that's where you have to sort of negotiate that difference. You know, how do you get to that agreement? That's why I mentioned that 338H10 is a way that both parties kind of win, because it's a stock deal and it's an asset deal. But you might have to pay a little bit more for it. Yeah.
I recognize that EBITDA is used as a general rule of thumb, but yet certain industries, it's multiples of revenue.
Right.
Multiples of clients, you know, I mean, it's subscription businesses, I mean, or real estate. I mean, there's so many different multiples that come into play. I mean, this is this fallback one.
Right.
But within industries, there's other ones that have become.
That's exactly right. Yeah, we always report things on multiples of EBITDA, but sometimes multiples of revenue, which when you look at a smaller business, in my opinion, is probably a more accurate reflection of the values of the business than a multiple of EBITDA. A couple of reasons, you know, EBITDA is managed heavily by the owners. It can be quite volatile. It can be subject to significant volatility from, you know, maybe one-time things that are impactful, whereas revenue is pretty consistent. So pricing off of revenue, I like a lot on the lower middle market. But you're right, some industries like a cable company would be priced off the number of subscribers, or probably, I'm dating myself when I talk about cable companies, talking about some sort of, you know, internet subscription service based on the number. So it's understanding how does that industry price its companies. Nothing personal, Jim.
Could you speak to the databases for the multiples? Because I think it would be a really good tool for prospective buyers to have as a baseline in negotiations, is where to find these averages.
Sure. So the real money is not in buying a business. The real money is owning a business that sells data to people that are trying to do this work. I mean, there's no risk. All you do is just you get cash flow. So we subscribe to the first one I showed with the pretty color bars is called GF Data. It's available through ACG, annual subscription. I mean, it's not inexpensive. So, I mean, you talk to your advisors who probably have these subscriptions, these databases. Talk to them about the data that they can pull for you rather than trying to get them yourselves. So GF Data, again, is a database of private equity transactions. This data here is from Deal Stats, which is from Business Valuation Resources. Again, annual subscription cost for that. There are other transactions of lower middle market. There's Biz Comps and I can't remember, Value Source. So there are a number of transactional databases that are large. Now these databases like this one, the data comes from folks like me or from business brokers or investment bankers that submit transactions, and if you submit enough transactions, you get access to the database for free. There's, you know, larger companies will use CapIQ for their information. That's probably not something appropriate for this crowd because it really is much larger transactional data. Plus, it's cost prohibitive, in my opinion. It's offensive how much they charge each year for it. But again, bottom line, talk to the people in your network. Again, your accountants should have access to these databases. Maybe even your attorneys, or if you're working with intermediary, they would have that information. Does that help?
Yeah, I'm somewhat self-serving on my banker. You can talk to your banker.
Okay, there you go. Talk to your banker. One more?
Yeah, so when we were, I think I'm good.
He's loud.
I'm loud, yeah. But you were talking about the different, you know, looking and pricing off different, be it selling, you know, units, whatever. It all comes down to cash flow, regardless of how, you know, somebody cable to date you. subscribers, however you value it. I mean, ultimately, it's going to come down to cash flow.
That's exactly right, because my subscriber number is not paying my debt or giving me my financial return. It's my net cash flow that is providing it. But the way we value it could be very different. Just means the multiple, an EBITDA multiple maybe is irrelevant for that business. So if you take away anything from this morning, I hope you take something away, is that you're going to hear average multiples all the time. Forget about average multiples. They're averages. It was not 61 degrees yesterday. It's much nicer. So really take some time, understand the risks in the business. Is this company less risky or more risky than other companies within this industry, and adjust your pricing accordingly. So with that, we're out of time. Thank you very much for coming this morning. Appreciate it.